There is famous quote on the stock market that says, "Bull makes money, bear makes money, but pig gets slaughtered." So how to not become a pig that is only a one that is a loser on the market? So the one thing I wanted to point out right here is that whenever you are buying or selling, you can make using the right tools make money, become profitable. But if you are just listening to the real bullshit, then you will eventually lose. And today we'll cover the topics that will help you understand the markets and economy better in order to not really lose all your fortune on the market. That's the crucial in order to being profitable. So the first rule of being profitable is to not lose money. And right now we are jumping to our presentation. So what is next with economy? Let me know at first whether everything works fine in order to justify and in order to find out whether we can continue our broadcast. All right, so it looks like everything going fine. Live is streamed, so we are going through first element. And what's next with economy? So inversion of everything. Right now we are dealing with yields that have been broken. Its secular downtrend. So we have since 85 by 2021 a trend that was a down, and that was symbolizing literally the expectation of inflation that were very low. Right now, as we are skyrocketing through this trend line, it means that there's right now the higher chance of prolonging inflation remaining in the economy. So an increase in the 10-year treasury yield suggests that long-term interest rates on the rise, and this can impact the economy in the following ways. At first, it might be problems with borrowing costs. So there may be an era of where the high yields can lead to increased borrowing costs for consumers and businesses. This can slow down borrowing, spending, potentially affecting economic growth. Not mentioning the housing market that right now we are dealing of course the problems right now with this interest rate being too high, making the housing less affordable, potentially leading to slowdown in the housing market. Right now we are also going through not maybe that high slowdown in housing market as there are still buyers, but at one moment they will eventually get shortage as when the economy get deterioration phase, the customers won't be that willing to buy everything as it's right now. The retail sales is still fine, but it may eventually slump. Also, another thing is the business investment. Rising interest rates can make it more expensive for companies to finance investments and expansion right now, also potentially impacting corporate profitability, and not mentioning that the inflation expectations may prolong in its time span. So bond sell-off is pushing many of headwinds, and the expectations of the bond market is that it will rise further. So the interest rate are expected to rise as long as the Fed's policy points for it, and the inflation right now is untouchable. Yes, it has dropped during latest months, but still we are very far from the inflation target. So this bond sell-off is remarking that the inflation is right here to stay for longer. That will discourage investments, that will potentially lead to financial distress, and that will eventually make stocks less attractive, supposedly as the valuations will at first are very high, but as the foundations of the economy will deteriorate. It will also get this potentially lower valuations on the stock market. So for now, there are many things we need to revolve around in order to assess the risk properly. So that's the time horizon that's unremembered during latest years. Never in the history of the US Republic have US Treasury returns fallen 3 years in a row, and that's what exactly is happening right now. So we cannot neglect this dip. The odds of Treasury returns falling for 4 consecutive years are very, very low. So the last time when we had similar environment, that was 1940s, and we all remember what has happened back then. What was the world looking like in 40s when the debt to GDP ratio was similarly high. In real terms, treasuries are expected right now to continue declining due to the unsustainable debt to GDP level, and we do not know how it will eventually end up. Will we end up at the 1970s type of inflation when we have inflation period over the 2 periods of times? And this all brings the things that we are right now dealing with very uncertain times. So let's look at assessing economic strength, and that's also what we've been talking about. Banks tightening lending standards, a consistent sign of recession. So whenever we were dealing with this high level of economic stress presented by banks, we were going through recession. So right now we can find that there is a very difficult moment for all of the small and medium size of companies. This data is pointing to potential weakness. So that's the argument that we are not in recession right now. Maybe still, I would say, only postponed in time. There are many factors that are pointing that those all add up to a possible recession, and the market is just pushing merely on this artificial intelligence hype, whereas the foundations of the market in the economy are really bad. Also, taking off this, the customer is not aware of what's coming. Credit card balances surge by 45 billion, reaching 1 trillion. Auto loan balances continue upward trend, increasing by 20 billion, and so on and so forth. Non-housing debt is rising. So we are not prepared for the supposedly worst time ahead. We have literally gone painlessly throughout the latest time of a crisis in 2020, as it was stimulus coming here and there. But right now, when the inflation will rise again, they won't have the tools in order to rescue and resuscitate the economy, as the inflation will be the really huge killer of our robustness. So those with high interest rate credit card debt may face challenges, while those without floating rate debt and substantial assets may benefit from increased interest income. So taking off this, by the end, scary debt ceiling is rising, and that's what we've just been studied lately as well. What about the market right now, you may ask? Shifting landscape. So S&P 500 profit margin is been reset after this pandemic time. So it's quite fine. Sentiment is crucial, however. The sentiment is pushing the valuations forward, but we don't care about what underneath, what may come afterwards. It's only about the current hype that is making the valuations higher. S&P 500 profit margin right now is at the level as it was back before the pandemic times, and that's what makes us think that at one side we may get through downturn, but there are many retailers that are still believing that is still another stop before heading towards 16 points of profit margin. So they are waiting for stimulus-induced type of a behavior of the government. I don't know. They will be supposedly disappointed. So right now there are many questions, not many answers. Also, as the money market funds are rising to that extent, and taking into consideration that there is a very huge optimism, and even though the S&P 500 experiencing significant rise, we may still get through a turmoil that will supposedly erase that latest gains, and that's why you need to put some money on the sideline. So for now, even though on earnings per share, when we just study the next thing over, so earnings per share, we'll get back to this later. Right now, we can find earnings per share has been reset, and we are right now going towards around 50 points. But during 2008 crisis, S&P 500 EPS hit a low of minus 23 points, and during the pandemic it was around 10 points. So that's what really gives us a point of reflection of what may come if the headwinds will persist for longer. So getting back to the hedge funds and asset managers are in opposite camps. So we can find that these are the mere divergences that right now finding out that we are going through supposedly something ahead, something out of control, as whenever those divergences are rising, as it was back in 2019 and 2020, something bad right then happened. So for now, it may result in very volatile bond futures, leading to margin calls and prompting the Fed to provide eventually trillions in stimulus. But taking into consideration that we are in this inflationary period, it won't be that easy. So that's why I would hang on with buying everything right now, at least by 100% of your savings. EPS fine yet? Yes, what I've just mentioned. S&P 500 EPS is a key metric that calculates the combined earnings per share for major US companies. It's right now in a on a high level. That's why if we just hit the possible crisis, this reset of those valuations will be absolutely remarkable. And when it comes to the price to sales implications, right now we are at 4 points, but it's notable that during the high optimism times, there is very often lower future returns. So right now, as we are dealing with very high and rosy type of a moods on the stock and crypto markets, it's better the time to think twice and hang on for a while whether everything is under control of Fed. So that's it in today's episode. Thank you very much for watching. If you have any questions or any thoughts about the topic, let me know in the comments or in the chat below the video. And for now, we are seeing each other tomorrow at 8 a.m. ET time.